All right. Again, if you do have any questions, make sure that you do type them into the chat box, as all raise hand functions and microphones have been muted on your end. So type in the questions and we will address them as they come up. So today we will be covering health savings accounts, self-directing health savings accounts, what it means to contribute to one, what the difference is between some of the different types of, quote, health saving account type accounts are, because there's a couple different out there between flex spending plans and Archer MSAs and the actual HSA, what it means to qualify, how to contribute, all the fun things that you wanted to know about these we will be covering today. Again, just make sure you type in your questions and I will address them as they come up. My name is Alex Perny. I will be your presenter today. I've been with Advanta since the beginning of 2012. I have been a member of the American Banking Association and the Trust Banking Association of America since 2014, and I hold my certification as a Certified IRA Services Professional in the realm of retirement planning as well. So if you have any questions, I am certainly able to answer them with regards to HSAs, anything about those, as well as IRAs, 401ks, defined benefit plans, any other type of retirement plan we can cover. So feel free, if you have a question, fire it off, even if it's not directly related to this. Okay, James asks, this is a little bit regarding an IRA, but it holds true for an HSA. Is there a time limit to use an account for investment property? That is, what if it takes 1 year to sell the property? And absolutely not. We have clients that have held rental properties in their IRAs, HSAs, 401ks for as long as we've been in business, and we've been in business since 2004. So you have as much time or as little time as you'd like to do and liquidate or hold the investments that you hold with these types of accounts. Now, before we get too far in this, we do have to give our obligatory disclaimer that we, as Advanta and our employees, do not provide investment advice, nor do we endorse any products. All information and materials today are presented for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and qualified financial advisors before entering into any type of investment. Frank, with regard to any handouts, as long as you got in this, we can certainly email you the slides, but there isn't any particular handout. But you can certainly get a copy of the slides. If you would just like to touch base and email me, I'd be happy to email that too. You'll have my contact information at the end of the presentation. So what is an HSA? The thing I like to define this very well for people is because there's a lot of different things that people kind of assume are an HSA, and they are varied, they are not the same, and they function very different from each other. And we're going to get right into those here in a moment with regards to what the different ones are. But an HSA, as its most technical definition would indicate, is a health savings account. It is a tax-advantaged savings account for individuals with high-deductible health care plans. And I'm going to be referring to high-deductible health care plans throughout the rest of this presentation as HDHPs, just kind of in the interest of brevity to make sure that we're not continually repeating that. So HDHP, high deductible healthcare plan, is what that's going to represent. And they can be used for a variety of things. You can use them for qualifying medical expenses. You can use them for investments and get tax qualified gains on those kind of things. So there's a lot of different ways that you can utilize this, not just in the traditional sense of putting a little bit of money away and then utilizing it for a medical expense. Now, the history of an HSA account, these aren't types of accounts that go back an extreme long way. They are well under 40 years old with regards to, their history in the marketplace. The National Center for Policy Analysis back in 1984 decided that there was a need to come up with something similar to a medical IRA, where people had the ability to do tax-qualified savings and investing for retirement purposes only, but to help mitigate the increase in costs of healthcare, there was an identifiable need for that back in the 80s. So that kind of got the very long, slow, and arduous process started of legislating what exactly this would mean. And the first stab at it happened in 1996 with the Archer MSA, the Archer Medical Savings Allowance Plan. So it introduced contributions to these plans by employers, but they were subject to payroll and income taxes for the employees, and the monies could not be rolled over year to year, so it was a use it or lose it type plan, and the adjustments are made to make the plans tax-free. So there was a lot of kind of a little bit little bit of a complicated basis calculation with regard to how you offset, how you file, and things like that. So the Archer MSA was certainly a good first stab at it, but it had a lot of issues. One big one was the kind of the use it or lose it and the inability to port those plans over to another employer as well. In 2002, the Treasury Department came out with the HRA. Now, the HRA is really what I like to tell people is what they most often think of as an HSA. When people say, hey, I have an HSA through my work, most of the time it's going to be a health reimbursement account where you get like a debit card from your healthcare provider and they can say, hey, you know, for anything that you'd like to charge to this, whether it be, you know, medicines, copays, all that kind of stuff, you can use it for. That's typically going to be an HSA or a health reimbursement account. Now, contributions to these years can be rolled over, so it's not a use it or lose it type scenario. And then when you have that basis, you can use it, you know, really for what you see fit for the qualifying medical expenses under the terms of your HRA agreement with that healthcare provider. But the balances when you leave the employer are lost, so you don't have portability with that. Now, that's all well and good. It allows you to do year-to-year rollovers. There's no use it or lose it, but it kind of takes the ability of the individual to determine how much they're contributing out of it. It's just a defined contribution type plan where you say, hey, here's how much we're contributing, we're matching, and it's just given to you. There's really no cafeteria aspect to it where you can pick and choose what you'd like to do. Now, the following year in 2013, HSAs are created, which is going to be the nucleus of what we're going to be discussing today, and they do allow portability from job to job. So you get rid of the use it or lose it, you get rid of the non-portability of these plans, so you can accumulate funds for medical-related expenses and retirement expenses over a long period of time, and you can use the funds for non-health care-related costs as well once you reach a certain age. So there's a lot more flexibility with these types of plans. However, you do have to have qualifying HDHP coverage to have an HSA, whereas the HRA account doesn't necessarily have to define itself along the same lines of high deductible healthcare coverage qualification. So, you know, there are a few different aspects to that, but just remember that even though the health reimbursement account, or the HRA, is contributed into by your employer, the HSA can also have an employer contribution aspect as well. So they're not just mutually exclusive as to which one you only add money to and which one your employer does. Understand there is a little bit of overlap. We're going to cover that here in a minute. So the HSA, FSA, and MSA are going to be defined right here. So created in 1996, they expired in 2005. The Archer MSA is going to be a very antiquated plan. You don't even really see these anymore except with some really legacy type things that have people that held on to them for various reasons. The Flex Spending Account, it is going to cover expenses not paid by insurance, including deductibles, copays, co-insurance, and under the ACA, you can carry over $500 carry over up to $500 year to year on that plan, and it's offered as kind of an additional item into your healthcare coverage through your employer. It is not portable, and the maximum contribution is going to be $2,600 in 2018 as well for that type of plan. So now, what's the big benefit of utilizing an HSA account? So the primary motivation for the government is that if you are saving for your own, if you're saving your own money, you're going to be more apt to be more informed about your healthcare choices, and that will ultimately lead to less frivolous healthcare claims and reduced cost of healthcare coverage by people only utilizing the care and coverages that they really need, since they are essentially paying more out of pocket for it. It is a special savings account just for healthcare expenses and utilized as a supplement to your health insurance coverage. It is portable, and the nice thing is that the contributions into this are going to be tax deductible just like a traditional IRA. So if you're trying to make your maximum annual contributions to an HSA and a traditional IRA, you can potentially almost be doubling your deductibility for those contributions on an annual basis, getting you relatively in the neighborhood of almost $13,000 or maybe a little bit more, in the low neighborhoods of $14,000 for deductible contribution limits, depending on if you have an individual or a family plan is going to kind of determine those maximums. So the big benefits of this is that you have tax-free growth on investments, just like an IRA, tax-free distributions, like a Roth IRA for qualifying medical expenses. So you get the deductibility of the traditional IRA for the contributions, and you get the tax-free distribution portion of it for qualifying medical expenses. So you get a little bit of best of both worlds for that. Now, keep in mind that the qualifying tax-free distributions have to be made for qualifying medical expenses, and we'll get into that in a minute. But just understand for that really nice tax-free benefit, it has to be for the qualifying medical expenses. Contributions, the HSAs are supposed to be a supplement to your HDHP and allow for non-covered healthcare expenses with tax-deductible money. So the way it breaks down, you contribute $3,400 to an HSA and get a tax deduction. At a 20% tax bracket, $600 to $88 in savings on your 1040. You have $3,400 of expenses and pull money out without tax rather than paying expenses with after-tax money. So to have $3,400 in after-tax savings, you would need $4,250 in earnings. So you can see, depending on which angle you're looking at it, whether it is the tax savings for the contributions into the HSA or the effective present value of the money in it to pay expenses without having to pay taxes and the expense. So essentially you're being able to pay the expense without having to pay the tax on the money that you earned in order to pay it. So essentially you can look at it as, if you're in a 20% bracket, you're getting a 20% discount on the actual medical expenses that you are paying for. So depending on your scope of view of what exactly is going on with this, you can really kind of see where the savings are going to be most utilized and how much sense it really makes if you have qualifying HDHP coverage to utilize an HSA account for investment purposes, for spending, for paying for those expenses. But the immense power of this as a tax savings tool can really be quite evident. Now, there are two different types of HSA accounts. There is an individual and a family HSA. The contribution limits are really the two main things, and obviously having to have a nuclear family that it covers. So it only covers the one individual solo healthcare plan. Family HSA covers all members of the family covered under the family healthcare plan. Now, they have to be covered under that HDHP in order for them to retain the benefit of being covered under a family HSA. So if your healthcare coverage is only simply for you, even if you have a spouse and 4 children, you can only have the individual HSA, because those individuals that you're trying to cover have to be covered under the HDHP in order for the qualifying coverage of the HSA to go to them, because the HSA is going to be attached to the covered individuals of that HDHP. So just understand that the coverage of the insurance is going to determine which type of plan you can have, whether that coverage covers everyone in your family or just you. And this is especially important for people that have multiple insurances. So if you have a supplemental insurance for your entire family, but only one person is covered under the HDHP coverage provided by your employer or that you have purchased just for yourself individually, then you may not be able to establish the family type HSA. You might only be able to qualify for an individual HSA. Ultimately, I tell people, call your healthcare provider and then make sure of the coverage that you have, and they're going to be the ones that are best suited. Just ask them very upfront. Say, hey, is this family or individual qualifying high deductible healthcare coverage for the purposes of establishing an HSA? It is kind of a mouthful, but they'll understand what you're saying because they do get asked that question quite often. So to qualify for an HSA, you have to meet 4 requirements. The first one that I have iterated is you have to have a high deductible healthcare plan. So that means no copay for office visits or prescription drugs, other than preventative care until you've met your deductible. Now, unfortunately, not to disparage any type of healthcare laws or anything like that, but the Affordable Care Act, with the way that it's structured, has greatly reduced the number of provided plans that do fit into that first issue. Is that you may have qualifying out-of-pocket and deductible limits, but if you do have copays for your office visits, it's going to preclude that plan from being able to have an HSA attached to it. So unfortunately for those individuals that may have ACA Marketplace insurance that does qualify the figures of what is needed for high deductible healthcare coverage, if you do have a copay, which a lot of those plans on the marketplace do, it is going to make it so that you cannot have that type of plan established for yourself or your family. So for 2018, self-only coverage deductible must be at least $1,300. For 2018, for the family coverage deductible must be at least $2,600, and the out-of-pocket maximums have to be at least $6,550 for self-coverage and $13,100 for family coverage. So as you can see, if anyone on here has gone through the marketplace and looked at the figures on what is being sold through the Affordable Care Act marketplaces, it's not hard to get to those numbers. I mean, in all honesty, they say high deductible healthcare. I mean, I personally view that as relatively low with how the deductibles are nowadays. So just understand that the figurative amounts may not always necessarily qualify. You need to really pay attention to whether or not you have copays for office visits or prescription drugs, and that might guide whether or not you can actually have one of these types of plans. Again, I tell people, call your healthcare provider, ask them if it's HSA qualifying coverage, and then go on that, because they're going to be the ones that ultimately are needing to make sure that they disclose to the government which ones are qualifying HDHPs for HSAs, because they need to have that done compliantly with what the IRS mandates for this as well. So they're going to know that information. You cannot have other healthcare coverage with regard to that covers you. So you can have vision or dental or long-term disability and workman's comp. You cannot be enrolled in Medicare and cannot be claimed or listed as someone else's dependent. So qualifying HDHP coverage cannot have other healthcare coverage except for vision, dental, disability, or workman's comp, cannot be enrolled in Medicare, and cannot be claimed as a dependent. So if you meet those four requirements, then we can move forward with getting you into an HSA. Now, how do you necessarily determine your qualification for making a contribution? As I said, there are, you have to have qualifying healthcare coverage, and these are annual contributions. So when exactly do you have to have that coverage established by? How much? Is it a proration, or what are you looking at for determining the amount of money that you can contribute into one of these plans? Now, that rule is covered under what's called the first day of the last month rule. So for the purposes of making a full year contribution to an HSA account, you're treated as having an HSA for an entire calendar year, so long as that HDHP is in place by December 1st of that year. So long as that, so if you were not covered from January 1 to November 30th, it doesn't necessarily matter. So long as that you have that HDHP qualifying coverage bound and in place by December 1st. You can make a full year contribution. However, you do have to maintain that HDHP for a full 12 months. If not, you are forced to take a pro rata distribution of the amount of money that is not covered under that the amount of time that you had the plan open for. So if you had the plan open for only 6 months and you made a full year contribution, that means that you're going to have to take a distribution of half of that plus taxes and penalties going back out to you, since you got a deduction for adding money into it. So just understand that you do need to maintain coverage for at least 12 months afterwards, and you only have to have it in 1 month, at least December 1st, in order to make that first full year contribution. So to exemplify this, Ben enrolls in an HDHP plan on November 30th, 2017. He can then contribute a full $33.50 to his HSA account for 2017 and take the deduction on his tax return. If he loses the HDHP coverage prior to November 30th, 2018, he must take a prorated distribution of the HSA account. Distribution is then subject to taxes and a 10% penalty. So first day of December, you have to have coverage in order to make that full year contribution into the HSA. Now, if you had coverage in November, October, whatever, it doesn't matter. Just so long as you have it by December 1st, you can make that full year contribution. So just a good thing to know, especially with the ability, especially with open enrollment for different types of ACA marketplace healthcare coverage, to understand when you really might need to look at that. If it's coming up and let's say you have an open enrollment at your job for qualifying healthcare, HSA qualifying healthcare, but that open enrollment runs from let's say November 1st to December 31st. Well, don't wait to enroll till after December 1st. Just understand that you might need to do that a little bit earlier. James asks, does the 10% penalty apply for someone older than 64? So the early distribution penalty is not going to apply if the individual is over the qualifying age to distribute, which is 65. So if you are meeting that qualification, because 59.5 is going to be the time at which you get rid of early distribution penalties for those that are in an IRA, 65 being the early distribution penalty age for those those in an HSA. So if you do that and you lose your HDHP coverage, you just have to take it as a distribution and pay taxes, but your early distribution 10% penalty would go away at that point. So contribution limits for an HSA account for this year, self-only coverage is $3,450. HSA for families is $6,900. Tack an extra $1,000 onto both of those if you are over the age of 55. Contributions must be made in cash. They cannot be made in kind with property or valuables, so you do have to make it with cash, U.S. dollars into these types of accounts. And you can do a one-time rollover contribution from a traditional or Roth IRA to an HSA. However, you cannot use a SEP or a simple plan for this, but you're still going to be bound by the contribution limit. So you can't say, oh, I have a $50,000 traditional IRA, I'm just going to do my one-time funding rollover into an HSA. You can only do that into the amount of $69 or $3,450 if that is, whether it's self-family coverage. So just understand that you can do that one-time rollover contribution, but it's going to be bound by the contribution limits as to how much you can put in there. So contributions can be made by an employee or an employer. So either person can contribute. If the contributions are going to be made as a deductible basis for the individual, they have to be made by the employee. If your employer is making it, it is not going to be a deductible expense to you. The employer is going to get that deduction. You are not. Deductions can be taken even if you don't itemize. So the important thing to understand with that is that in some cases with IRA custodial fees and other things, you have to itemize in order to maintain a deductible basis for some of those types of expenses or contributions. With an HSA, you don't have to itemize your 1040 in order to maintain the deductibility of those individual or family HSA contributions. And your contributions can be made up until your timely filing deadline, typically April 15th or whatever date that it is stated as, but you do not get an extended filing deadline for HSA contributions for this. So you have to make it up until your traditional Roth and HSA filing deadline of timely filing for that. So distributions from HSAs are tax-free regardless of age or how long the plan has been in existence, so long as the distribution is made for qualifying medical expenses and the expenses are incurred after the HSA is established. So if you had shoulder surgery in October and you establish your HSA in December, even though you can make that full year contribution by the first day of the last month rule, you cannot use those funds for paying that expense in a qualified manner from the HSA. If you wanted to use the HSA funds, you would potentially have to take it as a taxable distribution along with the penalty in order to pay that. So keep in mind that the expense has to be incurred on the day of or after the HDHP was established, so that way the HSA was established, so that way you can use it for the great tax qualified, tax-free distribution from an HSA. Now, what is a qualifying medical expense? Healthcare plan deductible, cost of doctor's visits, dental care, vision care. Only expenses not covered under by the plan. Medications, prescriptions, OTC medications. So if you are prescribed, a good example is prescription strength Advil. I think it's like 800 milligrams or Don't quote me. I'm certainly not a doctor. But things like that. If you are prescribed if you have a prescription use of an OTC medication, you can use HSA qualifying plans for that. But if you're just looking to stock up your family's medical cupboard and get things like things for indigestions, headaches, bandages, stuff like that, you cannot use an HSA for that unless it has been prescribed for you in order to be able to utilize them. If you want further clarification on that, IRS publication IRC 502 covers that in painful detail. If you're curious to get a little bit more information on it, I've read through it. It's not the hardest thing to understand, but it is a lot of information. So if you're curious to know really exactly where the fine lines are drawn with what you can and can't use it for, read through that publication. It will certainly answer all of your questions and may certainly drive some more. So qualifying medical expenses, chiropractors, bandages, disabled dependent care, long-term care, psychiatric and psychology care, and lodging care for medical expenses as well. So if you have to travel, let's say you're in Miami and you have to travel to Minneapolis for procedure, you can use your HSA in a tax-free manner, so tax-free distribution, in order to pay for your lodging for the medical care while you're on that trip. Now, there are certainly some non-qualified medical expenses. Not everything with healthcare is going to be covered with one of these types of plans. Healthcare plan premiums, except for COBRA benefits, are not qualifying medical expenses. Non-prescription drugs, again, if that non-prescription drug does have a prescription written for it for your use, then yes, it can be. Weight loss programs purely for vanity purposes, things like gastric bypass or medically required prescribed weight loss for disease treatment or something like that can be. Cosmetic surgery, teeth whitening, nutritional supplements, babysitting, healthcare clubs, medical expenses reimbursed by flex spending accounts or MSA accounts are also not qualified. So keep in mind that if you paid for something with an FSA or reimbursed from an Archer MSA, you cannot then in turn distribute that amount of money from an HSA in order to be reimbursed and not pay taxes on it, and payments for future medical expenses. So if you are billed something for a treatment that is coming up 2 months from now, you would need to pay that out of pocket, and then once the expense is incurred, then you could distribute money in order to reimburse yourself for that expense. So just understand that you have to have incurred the expense first. You can't pay ahead for qualifying medical expenses to get those good benefits from a HSA. Now, how do you reimburse yourself? So it's all great and wonderful to understand that you have the ability to do tax-free distributions from these types of accounts, but if the IRS comes knocking, how do you say, yes, that was for a qualifying medical expense? Well, the name of the game in this is going to be record keeping, and the ultimate responsibility of record keeping the expenses is going to be to you as the account holder. So you're going to need to make sure that you keep the receipts showing day, date, time, services performed, the amount of money, so that way you can show it as a qualifying medical expense. You might need to have a little bit more documentation to that effect, but essentially it's your responsibility to make sure that you record keep these types of items in order to be able to do the tax-free qualified distribution, so that you can make sure that it was indicated that the distribution was used exclusively to pay or reimburse for the qualifying medical expense. The qualifying medical expense had not been previously paid for or reimbursed by another source, and the medical expense had not been taken as an itemized deduction in any year. The third one's a really important aspect because you cannot claim a deduction if you are itemizing for a medical expense and then also reimburse yourself from a HSA. So just make sure you understand that if you are planning on taking deductions on your itemized 1040 for a medical expense, that you cannot then in turn also double dip and utilize the tax-free distribution from an HSA to reimburse yourself for that. So when and how can you take distributions from an HSA? We're going to enumerate it right here. So let's say Joe opens a self-only HSA and makes a full $3,400 contribution in 2017. Joe has $1,000 of qualifying medical expenses from May to December of 2017. At the end of the year, he takes a $1,000 distribution from the HSA tax-free. The remaining $2,400 plus any earnings remains in the HSA for future expenses. 2018, similar thing rolls around. Makes another $3,400 contribution. he has surgery costing him $3,000 out of pocket in that year. He takes an immediate distribution in March to pay the expense, leaving $2,800 in the HSA, and it accumulates $500, and he also accumulates $500 more of expenses in 2018. Now, really kind of where the compounding matter of these accounts is going to be illustrated. At the start of 2019, he has $28 plus earnings in the HSA, $500 in medical expenses, but does not take a reimbursement. In January, he makes a $3,400 deductible contribution to the HSA, and then during 2019, he has another $1,000 of qualifying medical expenses, but takes no distribution. So he has $1,500 of compounded expenses that he has not taken any distributions for. So 2020, $6,200 plus earnings in the HSA, $1,500 of unreimbursed expenses, and again makes his annual contribution and accumulates $1,000 or so in expenses. So $2,500 in expenses, no distribution from the HSA, 2 full years of full contributions. Fast forward 10 years later. At the beginning of the year, Joe has $60,000 in his HSA, contributions plus earnings over the past 10 years. So, if he's making max contributions over 10 years, that is certainly well within the realm, the possibility wheelhouse for how much money would be in this. In the last 12 years, he has had $20,000 of qualifying medical expenses, but took no distributions. Joe then takes $20,000 tax-free distribution from the HSA. So he's accumulated it, he's gotten the tax-deferred earnings, and then he takes a tax-free distribution because obviously you can earn more money on more money when it's invested through one of these types of accounts. So allowing it to compound, he can get more earnings on that $60,000 than he could on his initial $3,000, and then just ate the cost and then carried forward all of those expenses into 2030 and then took a tax-free distribution. So then in 2031, Joe decides that he wants to remove some of the funds from his HSA, but has no more qualified expenses. So what are his options? If he's under the age of 65, and this kind of goes into what James's question was, then the HSA are subject to income tax and a 20% early distribution penalty. If Joe's over the age of 65 or has become disabled, then the 20% does not apply, but the non-qualified distribution is subject to income tax. So now, what happens when an individual dies? So you can certainly name a beneficiary of an HSA, but there are a few stipulations to understand when it comes to actually how the beneficiary handles this type of account. If you name a spouse as a beneficiary, then the spouse can treat the HSA as their own, so they just inherit the HSA and use it for qualifying medical expenses. For a non-spouse beneficiary, the HSA ceases to be an HSA account, and the value of the HSA account as of January 1st is taxable to that beneficiary in the year you die. If your estate is the beneficiary, then the value of the HSA is included in your final income tax return for probate purposes. So just understand that if you are planning on utilizing an HSA, and you, especially for those individuals who are not married, the tax consequence of maybe doing distribution plans when you're nearing the end of life, or if you have the time in order to do some estate planning, is certainly something to look at because it is going to be a taxable distribution unless you have a spouse, in which case they can claim it as their own and then not have to pay income taxes on that type of on that basis of money in that plan. Now, that kind of covers mainly most of the functionality aspects of the HSA. Now, what can you invest with these things? It's all great and well to say, hey, yeah, you can invest in this and not pay any taxes and it just compounds. Well, that's awesome, but what are you going to invest in? Well, the relatively commonplace investments that we see a lot of are not what we specialize in. We specialize in the really interesting and the alternative aspects of what you can do with these plans. So you can essentially take your health savings account and buy a rental property with it. There's a lot of different kind of cool stuff you can do with these things in order to generate income for paying those medical expenses and then getting the benefit of having the tax-free distributions for qualifying medical expenses and the deductible contributions in there as well. So the kind of things that we see a lot of people investing with our company with these things are going to be real estate, private lending notes, and some other different types of products such as things like joint ventures, LLCs, private stock. oil and gas rights. A lot of different things can kind of fall into that category of other, but the main two things that a lot of people utilize these for are real estate, whether that be directly real estate, buying like a rental or a flip, or a promissory note as well. Now, there are some certain things that you cannot invest with an IRA, HSA, or any type of qualified plan. They're going to be life insurance and collectibles. The basics of what a collectible is anything that derives its value from subjectivity. So rare bottles of wine, artwork, antiques, baseball cards, things like that are things that you cannot invest the HSA directly into. And there are also some people you cannot invest with. So you cannot purchase directly or indirectly from your spouse, yourself, any lineal descendants or ascendants of you. So if you take yourself in your family tree and snap a chalk line directly up and down, so that's your parents, your spouse, your children cannot directly deal with any of those people, or a business entity owned or controlled by any one of the above. So if your son owns a business, your HSA cannot lend that business money if he's the sole owner, or if your daughter, let's say, owns a home and wants to sell it, you cannot buy that piece of real estate from your daughter as well in your HSA. It has to be from qualified third parties, essentially making sure that everything done in good faith at arm's length is the key to investing with an HSA. So a case study. So how exactly does this work? So you've made your contributions and your HSA has some money in it. So in this case, Heather wants to buy a fix and flip property and has $20,000 currently invested in mutual funds in her HSA, and thinks that she would probably realize better results with doing a self-directed format for this. So Steve is looking for a partner to buy real estate. Steve has acquired a property for rehab, and he needs $20,000 to cover the rehab costs and then sell the property. So in this case, Laura offers to lend Steve the $20,000 from her HSA and split the profit when the property sells. So how is this going to look functionally on paper? So the HSA is going to lend out $20,000. The equity participation, so the amount of money that the HSA is going to get at the sale of the property, is 25% of the profits, and there's a first mortgage securing the property held by the HSA. The payoff at the sale of the property with the profits are $30,000, so the tax-free income back to Heather's HSA on that $20,000 investment is going to be $7,500. So she is going to get a check at closing for $27,500. Zero taxes are paid, and she can utilize that in order to invest in whatever she sees fit into the next thing for her HSA. Okay, we got a question. Will asks, what if the business is owned by multiple people? For example, my son and an unrelated person. Can the HSA loan to their business? Potentially yes, but there are a lot of things to consider with that. I would greatly recommend getting with an attorney or a CPA that can advise to that, because they have to own less than half. They cannot, even if they own less than half, but their salary is more than half of the annual operating income of the business, that can preclude it. So there's a lot of different things to look at. We can kind of go through the rules with you, but it's just one of those things where the answer is potentially, but it's not a easily defined yes or no. But there is a potential for there to be lending to a business that your child owns, just so long as they don't own too much of it. And then in this case, Heather can continue to grow the HSA through additional investments or take tax-free distributions at some point down the road. So just understand with these things that there is a lot of things to consider with regard to qualifying for an HSA. Remember that you have to have the HSA established by December 1st of that year in order to make the full contribution for the year. Otherwise, you have to do a prorated distribution for that. That you have to have qualifying high deductible healthcare coverage, and that the best way to determine whether it is qualifying HSA healthcare coverage is to call your healthcare provider and just ask, is this qualifying HDHP coverage? And if it is, you can certainly establish the HSA therefore. That pretty much concludes the presentation today. I like to get people the basic information because these are often misunderstood plans that have a lot of things that go into them past just wanting to open one. So give me a call. We can go through your healthcare coverage. We can go through your investment options with these things. They are going to be just as varied and diverse as your IRAs and 401ks are. You're not just kind of locked into that money market mentality that you have with HSAs where you just go somewhere, get a debit card, and just literally plug money into it at less than 0.5% interest rate on that. You can really utilize these things in a truly self-directed manner to take back control and invest in what you know and with who you know for this as well. So again, this concludes our presentation. If you have any questions, feel free to email me. I do respond back to every email that I get with regards to questions on these things. It's been a pleasure having you here with us today, and I hope everyone has a wonderful and safe weekend. Thanks.